Greetings everybody, it is John Egg here, and I must begin with the portion everyone avoids stating publicly. Silver recently displayed a price which alters the whole discussion, $86.62 an ounce, an all-time high. Not high for the year, the type of figure that compels exchanges, banks, and large leverage traders to reach decisions rapidly. And here is the decision which is significant. If silver advances into the 90s and persists, the futures exchange, which controls Western price discovery, might need to select between allowing the market to proceed or utilizing the emergency brake. In this video, I shall guide you through precisely what transpired, why the margin hikes we recently witnessed are a massive warning sign, what the rulebook indicates the exchange can execute subsequently, and why a halt might not necessarily prevent silver as authentic price from advancing further regardless. And at the conclusion, I will provide two scenarios you must prepare for if we exceed $95, because one of them is chaotic, swift, and mentally taxing. So let us begin. Here is what occurred in simple English. Silver surged upwards to reach $86.62, and it functioned while the exchange persisted in rendering it more costly to remain long. That arrangement is uncommon. When margins ascend and price still climbs, it signifies the buying pressure is not merely momentum tourists, it is persistent demand. Now, if you have traded commodities for some duration, you already recognize the exchange as preferred tool during a melt. Up, they do not dispute the market, they escalate margin requirements. That is precisely what transpired during the previous few weeks. Margin requirements were increased several times within a narrow window. The final consequence is uncomplicated. You require further cash to maintain the same position, and every occasion the price attempted to breach a major level, margins ascended once more. The formal explanation is always risk management. Volatility expands, so the exchange desires further collateral. That is reasonable to a point, but when margin hikes arrive in swift succession, they are not merely supervising risk, they are also supervising behavior. They are attempting to dampen the trade, they are attempting to compel the most fragile hands to sell. And when the weak hands are evicted and price still ascends, that is when things become hazardous, because the exchange merely possesses a few levers. Margins are one lever, position limits are another, and the massive alarming lever employed solely when they suspect the clearing system is in jeopardy is a trading halt. So what might compel them to that point? It is not that silver is climbing and the exchange is annoyed. It is math. It is mark-to-market losses. It is clearing members contacting the exchange and reporting we are facing margin calls we cannot satisfy quickly enough. Let me clarify the plumbing, because if you grasp the plumbing, you cease being startled by the headlines. On a futures exchange, every contract is protected by the clearing system. If one side forfeits money, the other side profits, but clearing members, large brokers, and banks are accountable for ensuring the losing side compensates immediately. That is why the exchange prioritizes financial integrity. It is not regarding fairness, it is regarding survival. Now imagine a dense short position in a market that is escaping. I am not asserting every commercial short is malicious. Producers hedge, industrial users secure prices. That is typical. But in every commodity market, there are also massive players who short for liquidity, market making, and occasionally speculative positioning. When the price advances against them, it is not a discussion, it is a margin call. And margin calls do not concern themselves with your narrative, they concern themselves with your cash. So here's the inquiry: at what price level do the losses become painful enough that the exchange determines the most secure option is to suspend the game? In other words, where is the pain threshold? If silver is in the mid-80s today, the gap between stress and systemic stress might merely be another $10 to $20. Now, I wish to be perfectly transparent. I am not asserting I possess secret information. I am not forecasting that a halt occurs tomorrow morning. I am explaining the playbook relying on how exchanges act under pressure, so you are not caught unaware if the subsequent tool is utilized. And this is important because the previous time a significant commodity exchange utilized the emergency brake to safeguard the system, it produced a trust crisis that still persists. Recall the nickel situation. Nickel accelerated quickly, a massive short became trapped, price became vertical, and trading was suspended. Then trades were reversed, the tape was adjusted to safeguard the clearing system. That incident instructed every serious commodity trader one lesson. During a genuine squeeze, exchanges favor the clearing system, not your piece of IL. So when people claim that could never occur in silver, what they truly signify is I desire it does not occur to me. Desire is not a strategy. Now let us discuss the precise warning sign we recently received. Frequent margin hikes in a brief duration. If you are long a futures contract, increased margins signify you must provide further collateral. If you cannot, you close positions. That selling pressure frequently pushes price down, at least momentarily. You witnessed that pattern. Price falls after a margin hike. Everyone proclaims the top, and then the bid returns immediately. That progression informs you something vital. The exchange is attempting to retard the move, the market is resisting, and when the market resists, the exchange intensifies. So what is intensification? It could be another margin hike. It could be a surge, so immense that it effectively excludes smaller participants, or it could be a brief halt to facilitate orderly markets. That phrase, orderly markets, is jargon. It signifies we require time. Time for whom? Time for the losing side to obtain financing, time for brokers to deliberate, time for risk teams to prevent a member from failing. That is why a halt, if it arrives, tends to assist shorts more than longs in the current moment, if you are long and the market is roaring higher. The final thing you desire is your capacity to supervise the position being frozen. Now here is where this story becomes even more fascinating, and it is the portion most people overlook. Silver is not a single venue market. Yes, the Western paper price is largely impacted by futures trading, but silver sells internationally, multiple venues, multiple pools of liquidity, multiple physical pipelines. And currently, one of the loudest signals is overseas premiums. When one region consistently trades higher than another, it is informing you where the physical urgency resides, and when that premium expands, it becomes a vacuum. It attracts metal toward the superior price. That is how arbitrage functions. So if you ever witness headlines shouting, "Silver suspended on the major exchange," you must ask the subsequent inquiry immediately, where is the price still selling? Because if other markets stay available, price discovery does not conclude, it relocates. And if the physical market is constricted, that relocation can render the eventual reopening even more aggressive. This is the snare. A halt can suspend one venue, but it cannot suspend global demand. Solar manufacturers do not quit because New York paused. Electronic supply chains do not quit because someone requested a cooling. Off period, they merely pay further elsewhere. Now let us discuss warehouse reality, because this is the additional factor people disregard until it is too late. The future system depends on deliverable inventory. Not all inventory is created identical. There is metal, which is designated for delivery, and metal, which is resting in warehouses, but not assigned to delivery. When deliverable inventory drops, the system's flexibility drops with it, and when flexibility drops while price ascends, the likelihood of emergency measures increases. That is the functional reality. If the market is extracting metal out quicker than it is being replaced, shorts encounter a grim choice: obtain metal at higher prices, transition positions forward, or request cash settlement. And that is when you begin noticing the grim terms: cash settlement, force majeure, extraordinary measures. Once more, not a forecast, a playbook. And let me provide one further factor that almost never is analyzed: what happens to the public. As confidence when the rules keep shifting, every margin hike delivers a message. It states this move is sufficiently large that we are anxious. And the more frequently that message recurs, the more people begin inquiring. If the paper market is so secure, why does it require constant emergency adjustments? That inquiry is significant because confidence is liquidity. Now visualize this. Silver starts Sunday night powerfully, reaches $92 within minutes, and social media fills with screenshots. Monday morning, mainstream outlets present the same headlines: speculative frenzy, bubble behavior. Investors should be careful. Then silently, you receive another margin bulletin. If you have ever wondered why major breakouts feel draining, it is because the market is intended to fatigue you right before the next leg higher. So here is my cliffhanger for you. If the exchange cannot retard the rally with margins, what do they perform when $95 appears and buyers do not hesitate? That is the moment I am tracking. And if you are tracking too, press like so. I recognize you are here. Now here is the psychological trick that occurs in periods like this. The media narrative shifts to fear. They inform you volatility is hazardous. They inform you the rally is finished. They inform you this is a blow, off top, and occasionally, certainly, it is. But when a rally is caused by supply constraints and real demand, the fear narrative is frequently employed to remove people so larger players can adjust, because people who grasp the plumbing employ volatility to shift positions from emotional hands to patient hands. So do not permit the headlines to perform your thinking for you. Now, before I present the two scenarios for a breach above $95, I wish to include something for the people who appreciate the human side of this story. If you enjoy hearing silver-related success stories, the how did regular people actually triumph type of stories, there's a link in the description to another channel that centers on that. Give it a rapid subscribe and examine it. Some of the journeys are incredible. All right, returning to the pressure points, if silver reaches $95, we enter the zone where exchanges historically become very wary. Why? Because the velocity of the move tends to grow as price nears round numbers, stop orders activate, shorts cover, momentum funds accumulate, and the move can transition from grind to gap. That is where the clearing system begins sweating. Now let us create a basic image. Imagine a massive short position exists. As price ascends, losses ascend. If the short is a genuine hedge against physical, paper losses can be balanced by physical revenue. But if the short is larger than the hedge or timing does not align, then the paper losses become a genuine cash problem. The exchange can perceive that concentration and stress. Now, what occurs subsequently depends on one thing, liquidity. If the losing side can obtain liquidity, they endure. If they cannot, the exchange intervenes. So scenario 1 is the margin escalation scenario. Silver exceeds $90, races toward $95, and the exchange increases margins once more. Intensely, not a modest increase, a level that compels leveraged longs to demonstrate they belong. And what occurs immediately? Price fluctuates. You receive a grim flush. Commentators label it a crash. Everyone who purchased with too much leverage panics. And then the bid returns because the structural forces, constricted physical, global premiums, industrial demand, do not vanish. This scenario is intended to remove weak longs while allowing shorts time to reorganize. It generates volatility, but it does not necessarily conclude the move. Scenario 2 is the pause and reset scenario. This is where the exchange declares we require a cooling off period, and trading suspends for a brief window. If you have never endured a halt, here is what it feels like. You are trapped. You cannot supervise risk. You can merely observe. And if you are leveraged, observing is agony. The exchange describes this as protection, but the authentic function is time. Time for margin calls to be satisfied, time for positions to be settled, time for the system to prevent a member default. Now here is the cliffhanger. A halt does not ensure the reopening is lower. Occasionally the reopening is higher, far higher, because while one venue is suspended, other venues persist in pricing the metal, physical markets persist in trading, premiums persist in signaling scarcity. So when the suspended venue reopens, it must reconcile with reality. So inquire of yourself, if the exchange halts at $97 and other markets trade up to $103 while it is closed, where do you suspect it reopens exactly? And the instant it reopens, the exchange frequently joins it with new margins. That is how they maintain control, which signifies the initial hour after a reopening can be chaos, gaps, stops cascading, forced liquidation, and then the most powerful buyers entering. That is how markets relocate ownership in a crisis. Now I wish to expand, because the halt story is merely one layer of the larger silver story. Why is silver acting like this? Because fundamentals have been tightening for years, and then suddenly the market began to concede it. Silver possesses a supply problem, it possesses a demand problem, and it possesses a trust problem. Supply, bringing new silver to market, is not rapid. Most silver is generated as a byproduct of other metals. You cannot merely activate a switch and double output. Demand, industrial use persists in climbing, especially where silver possesses no genuine substitute at scale. Trust, when people perceive exchanges altering rules mid-move, they trust paper less, and they gravitate toward physical and fully allocated exposure. Those three pressures support each other. Tight supply renders premiums higher. Rising premiums exhaust inventories. Exhausting inventories increases fear of delivery stress. Fear increases demand for physical, and that demand constricts supply further. It is a feedback loop. And feedback loops are why moves that appear impossible can occur quicker than anyone anticipates. Now return to the functional question, what does a halt signify depending on what you possess? If you maintain physical silver, a futures halt does not freeze your metal. It does not seize your bars. It can generate headline volatility, wider spreads, and larger premiums. But if a halt occurs because the clearing system is stressed, that is not a sign physical is weak. It is a sign physical is defeating paper. If you maintain futures, a halt is distinct. Your position is linked to that venue, and the exchange can alter the rules while you are trapped. If you maintain ETFs, you obtain liquidity, but you also receive structure risk in an intense squeeze. Creations can decelerate, discounts or premiums can manifest, and people suddenly worry regarding what backed truly signifies. If you maintain miners, you possess leverage to price, but you also possess business risk, cost inflation, jurisdiction issues, and operational problems. So there is no one perfect vehicle, there are merely trade-offs. Now, I wish to ask you two inquiries because your responses inform me where you suspect this is headed. First, do you suspect a trading halt would actually soothe the silver market, or would it render people desiring physical even further? Second, if silver reaches $100, do you anticipate the exchange to increase margins once more, or do you suspect they proceed directly to emergency measures? Submit your responses in the comments. I review them, and they influence what I analyze next. Now here is the final layer, and it is the one that keeps me tracking this market, like it is a live wire. If silver persists in rising in deliverable inventory, persists in falling, the conversation eventually moves from price to settlement. In typical periods, nobody worries how settlement functions. In stressed periods, everyone worries, because if too many people request delivery and the system cannot deliver quickly enough, the exchange must adapt. That is where you receive the nuclear options: liquidation, only position reductions, extraordinary action. And those words, further than any chart, are what initiate a stampede into physical. So the way I am considering the subsequent phase is basic. If silver advances from $86 towards $90 and hesitates, anticipate further margin hikes. Further, this is the peak headlines and further intense fluctuations. If silver cuts through $90, accelerates into $95, and does not look back, then the likelihood of emergency measures increases rapidly. And if you awaken one day to a trading suspended headline, do not consider it as a random shock. Consider it as a signal you have entered a new regime, one where the paper system is laboring to contain a physical reality. Now, I shall conclude with a simple thought. You do not require forecasting the exact day or the exact price to prepare. You require understanding the mechanics and the tools the exchange employs when pressure grows, margins, limits, halts. And when those tools manifest in clusters, it is usually not because nothing is transpiring. It is because something is transpiring and the system is attempting to remain whole while it transpires. If you obtained value from this, subscribe immediately, rapid click, no drama, merely subscribe, so you do not overlook the subsequent update, because if silver advances into the 90s, the story alters quickly.